Hi, I'm Paul Mowbray, President of Mowbray Wright Financial Investment Planning Council. In this video, I will show you the details of an RRSP, a Registered Retirement Savings Plan. A Registered Retirement Savings Plan is a savings account that is registered with the federal government. It is in place to help you and encourage individuals to save for retirement. RRSPs have special tax advantages that make them an excellent option for saving for those golden years ahead. All Canadians can open an RRSP at any age, as long as they have earned income and file a tax return. You must open your account before the age of 69 and are required to close your account by age 71 by converting the account into a RIF, a Registered Retirement Income Fund. An RRSP is the account you use to save and grow funds, and a RIF is how you withdraw those funds for income once you have retired. If you're interested in exactly how a RIF works, you can view the video on our website that explains it in more depth. If using an RRSP restricts your options in terms of how you can invest, don't worry. There's a wide range of investment options. Qualified investments that you can hold in your RRSP include cash, GICs, stocks, ETFs, bonds, mutual funds, just to name a few. Prohibited investments that you cannot hold in your RRSP include real estate, debt, and other investments which you hold interest of 10% or greater. The cost of retirement is ever increasing. More money is needed in order to be able to enjoy your golden years. Financial planners used to base saving for retirement using the 20-year rule. People would retire at 65, and very few would live past 85. Now, with increased life expectancy, improved medical care, and people wanting to retire at an early age, people need a greater amount of funds and need to invest more intelligently in order to be able to have the financial freedom in retirement, perhaps a 40-year retirement. An RRSP will help you grow your money by lowering the tax burden on your savings and helping to make your retirement enjoyable and worry-free. Golfing or fishing 5 times a week sounds pretty good to me. Let's make that possible. Well, there's 3 main tax advantages in an RRSP. The first, the contributions are tax deductible. The amount that you contribute to your RRSP is tax deductible on that year's income tax. For example, if you live in Ontario and have an income of $100,000, you would normally have an after-tax income of $73,875, and you'd end up paying $26,126 in income tax. If you contributed $10,000 to your RRSP, you would save $4,341 in tax for that year, lowering your tax payable to $21,875. You've deferred 43% tax on every dollar contributed to the RRSP. You still have to pay tax on the money when you withdraw it in retirement, but at that point in time, your income will likely be lower, making the tax payable lower as well. All funds that are in an RRSP grow tax-free. It is this benefit that is often overlooked by most people. Not paying tax on growth, dividends, or interest can have a huge impact on the rate of return and the overall growth of the RRSP investment account. As an example, a 7% rate of return within an RRSP would be equivalent to a 12.3% GIC in a non-RRSP account. Same after tax return. Advantage is that you can control the timing of withdrawals and therefore the taxation of your income. Unlike pension payments of the old defined benefit pension plan, you decide when and how much to withdraw from your RRSP, or perhaps at that stage in life your RIF. This allows you a bit more control of income, taxation, and OAS clawback, etc. Don't like etc. Also, unlike pension plans, the remaining balance of the registered account survives you and can be transferred tax-free to a surviving spouse's RRSP or RIF upon your death, or after tax to your children via your estate. Using RRSP funds prior to retirement for other life goals. You can borrow funds from your RRSP to buy your first home. You can take out up to $25,000 for a down payment on your first home under the Home Buyers Plan, tax-free. You can also pay for your own or your spouse's education. Using the Lifelong Learning Plan, you can take up to $20,000 from your RRSP, tax-free. You can contribute up to the lesser of the following two limitations: 18% of your earned income in the previous year, or the maximum amount for the current year as outlined by the CRA. The maximum has increased slightly every year since being $13,500 in 2002. The current maximum for the year 2015 is $24,930. I recall the RRSP maximum being $2,000 per year. You can add up to that maximum any unused RRSP contribution that you did not use in past years. All of the above advantages, with special attention to the magic of tax-free compound growth, means there is no reason to wait until you're older to start an RRSP. The younger you open an RRSP account, the more time you have to let time do the work. You don't have to. Invest young and let your money grow. When is the best time to start if you've not already opened an RRSP? Now. I hope this video has shown you the benefits of opening an RRSP for your retirement planning. If you need additional assistance, please contact me. I'm Paul Mowbray, and I'll see you in the next video.